Venture capital, VC, is a type of private equity financing that is provided to early-stage, high-potential, and high-risk startup companies with significant growth potential. Venture capital firms invest in these startups in exchange for equity, or ownership, in the company. The goal of venture capital is to help startups grow rapidly and achieve a successful exit, typically through an initial public offering, IPO, or an acquisition. Here's how venture capital supports startup growth. Seed funding. Venture capital often provides seed funding, which is the initial capital required to develop a business idea or prototype. This funding is crucial for covering early expenses such as product development, market research, and building a founding team. Early-stage funding. As the startup progresses beyond the initial stages, venture capital firms may provide additional rounds of financing, known as Series A, Series B, and so on. Each funding round aims to support the company as it achieves key milestones, such as market validation, product development, and customer acquisition. Strategic guidance. Venture capitalists bring not only capital but also valuable expertise and industry knowledge to the startups they invest in. Many venture capital firms have experienced professionals who can provide strategic guidance, mentorship, and networking opportunities to help startups navigate challenges and make informed decisions. Scale-up capital. Venture capital enables startups to scale their operations and reach a larger market. This includes expanding the team, investing in marketing and sales efforts, and potentially entering new geographic markets. Access to networks. Venture capitalists often have extensive networks within the business and investment communities. They can connect startups with potential partners, customers, mentors, and other resources that can contribute to the company's success. Risk capital. Startups, especially in their early stages, often face high levels of risk and uncertainty. Venture capital provides risk capital, meaning investors are willing to take on the risk of failure in exchange for the potential of high returns if the startup succeeds. Exit strategies. Venture capitalists aim to realize returns on their investments by supporting startups until they achieve a successful exit. This can take the form of an IPO, where the startup goes public, or an acquisition, where a larger company buys the startup. The profits from these exits are then distributed to the venture capital fund's investors. Innovation and economic growth. By supporting innovative and high-potential startups, venture capital contributes to economic growth and technological innovation. Many successful companies that have transformed industries and created jobs received initial funding and support from venture capital. It's important to note that venture capital is not suitable for every type of business. Startups seeking venture capital should have a scalable business model, a large addressable market, and the potential for significant returns. In return for the funding and support, startups give up a portion of ownership to the venture capital investors.